Welcome to The Explainer. Back in 2008, the entire global economy pretty much hit a brick wall. And it all started with something that seemed incredibly safe: American homes. So today, we're going to break down how a housing boom in the US managed to trigger a worldwide financial meltdown that, honestly, we're still feeling the effects of today.
In the fall of 2008, let me tell you, this was not some dramatic overstatement. The global economy was genuinely staring into a black hole, and you had world leaders using language you'd expect to hear in a disaster movie. The whole system that moves money around the planet was just seizing up, and a complete collapse felt terrifyingly possible. Yeah, this is what pure, unfiltered panic looks like. On September 29, 2008, the Dow Jones dropped by nearly 778 points. At the time, that was its biggest single-day point drop in history. And this wasn't just numbers on a screen, This was the sound of trillions, yes, trillions with a T, of dollars in wealth just vanishing into thin air. It was a total loss of confidence.
So, the big question is, how on earth did it come to this? How did a problem that started with some home loans in America manage to nearly bring down the entire global economy? Well, the answer is this toxic chain reaction of risky loans and incredibly complex finance. To really get it, we've got to rewind a few years and find that very first domino.
So it all kicked off in a place that everyone thought was rock solid, the safest place you could put your money, the U.S. housing market. For decades, the golden rule was that house prices only ever go up. And well, that one assumption, it turned out to be absolutely catastrophic. Just look at these numbers. Between 1998 and its peak in 2006, the price of a typical house in America soared by an incredible 124%. Now, to put that into perspective for you, a house normally cost about 3 times what a family earned in a year. By 2006, that had jumped to almost 5 times. We were in a massive, and I mean massive, housing bubble. So what was fueling this whole thing? Well, it was the explosion of something called subprime mortgages. Basically, these were loans given to people who, let's be honest, were a pretty big risk, people who probably wouldn't be able to pay them back. Lenders who were swimming in cash and enjoying low interest rates started handing out loans to borrowers they would have turned away just a few years earlier. It got so crazy that by 2006, a full one-third of all U.S. mortgages were either subprime or required pretty much no real paperwork. This led to the infamous ninja loans. And yes, you heard that right, no income, no job, no assets. The whole thing was a house of cards, built on the wild hope that rising house prices would just magically cover any problems.
Okay, so you've got to be asking yourself, why in the world were banks handing out these obviously risky loans like candy? Well, the answer is pretty wild. It all comes down to a clever and ultimately disastrous financial trick that let them make a quick buck and then pass the risk onto somebody else. And that trick was called securitization. Here's the basic idea. Investment banks would swoop in and buy up thousands and thousands of these risky mortgages. Then they'd bundle them all together, chop them up into these really complex new financial products, and sell those little slices to investors all over the globe. These products were called mortgage-backed securities, or MBS for short, and boy were they popular. Pension funds, insurance companies, even other banks. Everyone wanted a piece because they were looking for what they thought was a safe, steady investment. And here's the real kicker. The big credit rating agencies, they stamped many of these super risky bundles with a top-notch AAA rating. That's basically saying they were as safe as government bonds. Spoiler, they weren't. And this is the most important part to understand. The person who originally made the loan, they didn't care anymore if the homeowner could actually pay it back. Why? Because they'd already made their profit on fees before selling the mortgage and all the risk that came with it down the line. The entire financial system was basically playing a giant game of hot potato with toxic debt, and nobody had any idea when the music was going to stop. So this whole complicated, global system, it all balanced on one single, incredibly fragile idea: that U.S. house prices would just keep going up forever. But in 2007, that idea didn't just bend, it completely shattered. So what happened? Well, interest rates on all those risky mortgages started to climb, just as house prices finally started to fall. All of a sudden, millions of people owed way more on their house than it was actually worth. Defaults just skyrocketed. And those safe mortgage-backed securities, they weren't just a little risky anymore. They were toxic, basically worthless.
And that brings us to the absolute mayhem of September 2008. The chain reaction was just breathtaking. First, the government had to step in and take over the mortgage giants Fannie Mae and Freddie Mac. Just a week later, boom, Lehman Brothers, a massive investment bank, goes bankrupt. It was the biggest bankruptcy in U.S. history. The very next day, the insurance behemoth AIG needs a colossal $85 billion government bailout just to stay afloat. I mean, the dominoes were falling so fast, nobody could keep up.
The result was just absolute pure panic. Think of it this way. Nobody knew who was holding the bad debt, so banks completely stopped trusting each other. They stopped lending to each other. And that flow of credit, it's like the essential plumbing of the global economy. And it just froze solid. This was no longer a Wall Street problem. This was a full-blown global emergency.
You know, the fallout from this financial earthquake, it wasn't just contained to Wall Street skyscrapers. It hit Main Street, and it hit hard. This was felt in regular households all across the world.
Just look at this number, 8.7 million. That is a staggering figure. That's how many jobs just disappeared in the U.S. alone as this whole mess kicked off, what we now call the Great Recession. We hadn't seen an economic downturn that bad since the Great Depression in the 1930s.
And the human cost was just immense. I mean, it was deeply personal for so many people. Unemployment in the U.S. shot up, basically doubling to 10%. Trillions of dollars in family savings and home equity wiped out. Millions of families lost their homes to foreclosure. It was a period of really widespread and long-lasting hardship.
So what did we do about it? Well, governments all over the world had to step in with these unprecedented rescue packages. In the U.S., you had the massive $700 billion TARP bailout just to keep the banks from totally collapsing. That was followed by the Dodd-Frank Act, which was this huge overhaul of the rules for Wall Street, all designed to make sure something like this could never, ever happen again. And there were new international banking rules, too.
Which, of course, leaves us with the big, lingering question for today: is the system really any safer now? Sure, we have a bunch of new rules, but finance is always changing, always innovating. The world learned an incredibly painful lesson back in 2008, and you can bet the echoes of that lesson are still with us today.